Happy Thursday, everyone. So I was really close to giving you guys my most exciting video on implementing the opening gap strategy with interactive brokers with IB-Insync and showing you at 9:30 Eastern when the market opens the strategy in action. Unfortunately, I made one typo and at 9:30 I got an error. So I figured it might actually be smarter if we go through the implementation of the strategy more slowly, not in a rushed way. And then I'll do a few live streams showing the gap strategy in action. I think that's the best approach. So of course, if you guys get value out of my videos, please like, subscribe, and share, comment, do whatever. I promise I won't ask every time, but thank you guys so much. Anyways, let's get started. So this video builds upon my previous video where we tried to predict if the opening gap will be filled or not. So I'll give you an example, and I actually realized I made a mistake here. But like an example could be like, look, this is a red candle, which means this is the open, this is the close, and this is the low, this is the high. So the close is here, right? And the next day is a green candle. The open is here. So this is a gap up, right? But the green candle never gets below the previous day's close. So the gap is never filled, okay? But an example of a gap fill can be something like this. Here's an example of a gap filled. So these are two green candles in a row. I know I wrote gap filled here, but actually it was not filled. Here's an example of a gap filled. So like you have two green candles in a row. This is since it's green, open, close, and then here is open, close. So as you see, the close here is above the next day's open, right? But as you see, that the high of the day is way above yesterday's close. So this gap is filled on this day. So in this notebook, we showed you how to predict gap fills. We use features like relative volume, like relative dollar amount traded of like today versus like the last 14 days, for example, that sort of thing. I'm going to basically show you guys how to use that model and do the gap fill trading strategy. But I'm not going to use the actual model. That model was terrible. I'm going to actually use the worst model. I'm going to use a dummy model that always predicts the gap will be filled. So anyways, let's get started with the actual video. One second. Okay, so we're going to need NumPy and pandas. Okay, so we're going to connect to interactive brokers as always. And just real quick, let me give you a few gap fill ideas. Okay, so let me actually get the screen back. Okay, so one idea is basically, this is an example of a gap fill, this specific one. So one idea is, okay, this is gapping down because the open today is lower than the close of yesterday. So one idea is when the market opens, you buy at the market and you take profit as the previous day close, so it's here, and then you put maybe some sort of stop loss here. So that's one example. Another thing you could do is you could have some sort of limit where like, okay, what if the market is open, you set a market order and it already jumped above this thing? That would be bad. So you can have some sort of limit to protect yourself. Like let's say you could have the limit at the open itself, for example, or you could be more conservative, have the limit below, and then you could still take profit at the gap fill. And then you would have a stop loss. I like wide stops, but everyone has their own trading strategy. So that's one example of something you would do. Okay. Another example is, so that's for a gap. This is for a gap down because the open here is below yesterday's close. Okay. So, so here's an example of a gap up, right? So because this is a red candle, this is the open of this day. And this is the close of yesterday. So the open is above yesterday's close. What you can do is you can short, and then you can take profit at the gap fill. And that would be another way. So that's with stock trading. Okay, but there's two other things you can do. I wrote them down here. Is like, okay, so there's two other strategies. The stock trading is the easiest one. It's for beginners, but selling options is actually probably less risky. So if there's a gap up, you can basically sell a call option and take profit when the gap is filled. Why is this less risky? It's less risky because the break even for selling an option is less, and also time decay works in your favor. Of course, you should not be selling naked calls. So this strategy with the selling the call would work best if you do not have the stock itself. And then if the market gaps down, you can do a different strategy. You can sell a put option, right? And when the gap fills, you can close it. I'm not going to talk about the strategy here, but if you're interested in seeing a video about it, I definitely am more than happy to discuss it. I tend to be doing these selling option strategies instead because I view them as a lot less risky. And then you can do the steroid thing, which is basically trading spreads. So I wrote higher risk advanced level. So basically, if you have a gap up, you can basically buy a bear debit spread, or you can basically sell a bear credit spread. And if there's a gap down, you can do my favorite, which is buy a bull debit spread or sell a bull credit spread. And then when the gap is filled, you can take profits. So these are highly leveraged. You can make a lot of money and you can lose a lot of money fast. I still think this is slightly better than just buying the actual call or buying the actual put option because of the fact that when you have a spread, your theta your theta, your time decay is less of an issue. But it's very risky, but I'm just giving you an example. So of course, if you guys want to see this, please make comments and I will make videos about it. But we will focus on just the stock trading where like you buy at the open and then you close when the gap is filled, and you'll set a stop loss. We'll talk about that soon. You can have. I recommend. This is not. By the way, this is not financial advice because this is a serious trading thing, and assume everything I'm telling you is wrong. In fact, but like the higher the wider the stop loss, the more likely you are to win the trade. If you have tight stops, you can often be stopped out and lose. So anyways, I just wanted to give you guys first, before we start, a few notes on gap fills. So basically, I got this idea from this book called John Carter, Mastering the Trade. And I have it on Audible. Let me show you guys for a second how the book looks like. So it's like this, Mastering the Trade. It's a pretty good book. The narrator is really good if you have the Audible thing. So basically, he really loves the opening gap play. He says it's the highest probability trade of the whole day. He prefers doing it on indices and not individual stocks. He says individual stocks could be bad idea for gap play. So basically, for indices, he has all this criteria. Like let's say the volume is not that. He uses things like day of the week and volume, the combination of those two. And if the relative volume is not that big, the gap is likely to fill. And it's dependent upon the day of the week, but also things like if you have option expiry and things like that can throw things out of whack. But basically, the intuition is the lower the amount of basically pre-market volume or action, the more likely it is to fill. But of course, you can have something like, let's say Microsoft has earnings, Microsoft tanks, it can throw the entire index out of whack. So Microsoft is the highest in the QQQ index, for example. And if Microsoft tanks, it can throw the whole index out of whack, and there's a chance that the gap will never get filled. And just a quick note, if you're trading and you're using indexes like QQQ, ETFs like QQQ, SPY, that sort of thing, when doing the gap fill, you have to adjust for dividends. It's very important, but that's a side note. For individual stocks, he doesn't like it as much, but he does say that a lot of times you can have as a candidate for a gap play a stock like, let's say the whole market is green, like by 1%, right? And then you have like a stock like Tesla that's green with the market. And let's say Tesla's beta is a little bit higher, so Tesla's up 2%. But there's no specific news on Tesla, no high amount of volume. In fact, there's a low amount of volume. So Tesla could be a good idea for a gap play. So in that case, if it's gapping up, you would short Tesla. I never short. I hate shorting. I don't bet against stocks usually. So, but anyways, that's just the idea. Okay. So the game plan, which is no longer valid right now, was between 9 and 9:30. You basically will register for historical bars. We'll keep them up and running, and as soon as the market opens, we'll calculate like our pre-market relative volume features, day of week, gap percent, and we'll make a prediction whether the gap will fill or not. And then we have all these criteria like let's say minimum gap percent for us to be willing to make the trade and that sort of thing. And based on that, we can make the trade. So let me first, I'll explain this thing in bigger detail in a bit. So I actually wrote it here. Once you get the bar, once the market opens, you calculate the features for the model. You make a prediction if the prediction is above like some threshold, and the gap is greater than the min gap percent, like the minimum gap percent you're willing to make a trade, then you take the trade. And I'll explain this more in a bit. I just wanted to review two tiny concepts before we move on. One is bracket orders with IB-Insync. So bracket orders with IB-Insync is okay. You know what? Before that, I'll actually do it in reverse order because you need to define a stock to have a bracket order. So I'm gonna review for a second. Requesting historical data and keeping up to date is true. I do want to note that for this thing, this is not robust against internet disconnections. So you have to be careful with that, but it's the easiest thing, so I'm going to show it right now. Okay, so let me show you guys how this works. Okay, so you basically do something like bars equals ib.rec historical. First of all, you define your stock. So to be honest, most of the stocks filled their gap already today. So let's do Airbnb, which is gapping down. So I'll do symbol equals ABNB. It hasn't filled yet. Again, you should not run this. Now it's 11:30 Eastern. You should have run this pre-market. But like because I messed up, I'm just showing you the idea. So I do symbol equals Airbnb, exchange equals smart, currency equals USD, IB.qualify contracts, stock. So this gives me Airbnb stock. And then to get market data, I would do something like this. I would do bars equals ib.rec historical data stock. This means until the current time. Bar size setting, I'll do 5 minutes. And then I'll do what to show. I'll do trades. I'll do use regular trading hours as false because we want to calculate the pre-market features. And keep up to date. Let's do true. That will keep updating this thing. So just 1 second. I forgot I needed the duration string, and I'll do 30 days so we can compute like the relative pre-market volume features. So how does this look? You have this bars thing. And remember, the last bar looks like this. Let me actually show you as a data frame. You have bars. So the last bar is the the 5-minute bar from 11:15 to 11:20. It's not 11:20 Eastern yet, right? So this is not a complete bar. So, but if I refresh every 5 seconds, it's updating. You see the volume increased. Here the volume is 7.9 something. I do this again, it'll be 8 something. So every 5 seconds the volume is increased, right? And just to show you something, I can have a callback. I can do def def on bar update. Bars has has new bar. What did I do? And then I can do something like if has new bar, print has new bar. And then I also, no matter what I want to do print util.df bars.tail 2, tail 3. No matter what, I want to print that, right? And I also want to print the time. So I want to print datetime.now. So I want to show you what's going on here. And then to attach the callback, you do bars.update event plus equals on bar update like this. Okay, so we just made it in time. Oops, what did I mess up? So we're gonna have to wait 5 minutes. Oh, datetime has no module called now. Ruins my my plan. We don't have now. I needed datetime.now. Okay, I see. Okay, so why don't we just clear this callback, and we'll wait 5 minutes to we'll wait a bit of time, and we'll get back to this callback game. I needed to do datetime.now. I just wanted to illustrate a concept, but I need it around the new time of the new bar. So just to show you guys something. So anyways, let's get back here. Just a reminder on bracket orders. Let's see, 34%. Okay. So what is what is a bracket order with IB-Insync? You can do IB.bracket order, and then you can do action equals by. You can do quantity equals 100. You could do you have a limit price. So this was getting historical Airbnb data. I could have also got market Airbnb data. So like, let me write get market data for Airbnb for stock. So it would be something like stock ticker equals IB.rec market data. False stock, and then you can wait a few seconds for it to fill. Okay. So by the way, this has like has open, has close. That's yesterday's close. You see it gap down a lot. By the way, pre-market, this open is NAN, but because I started this after market, it's not NAN. But if I do now stock ticker, I can do dot high. This is the high of the day. See, it has not filled the gap. It's probably not going to fill the gap because it had earnings, but I just want to illustrate the concept. And then you can have like market price, for example. You see the market. So right now Airbnb is trading around that thing. Click it again, you'll get a different number. Okay. Basically, let's say Airbnb is around here. We can have like a limit. When we do our bracket order, we can have like a limit price of like, let's say 148. And then we can have a take profit price of 150. I have another video on bracket orders, and I can put it in the description where I talk about those more in depth. Stop loss, let's make it like 142, just to illustrate the concept. So this gives you a bunch of orders, bracket orders. and they look like this basically. They're individual orders with like a parent, which is the original limit, and then you have a take profit and a stop order. And oops, sorry. So then when you place orders, you have to iterate through these orders. You have to do for order in bracket orders, IB dot place order, order. So this places all the orders, right? Order in bracket orders. Oh, you have to do stock order. Okay, so this placed the orders. Okay, so you can basically you can look if we got any fills of the orders. So we did fill. We bought Airbnb. You can maybe look at it like this. It might be easier. So we bought Airbnb. This is Airbnb. If we want to know what price we bought it at, we can do something like fill the execution for fill in IB.fills. So we bought Airbnb at 147.98, right? And this triggered two other orders, right? So we can look at open trades. I might be all over the place because we have to get back to the other thing. So you do IB.open trades. Let me maybe write this for trade in IB.open. You know what? There's open trades, but you can also do open orders, I guess. And you know what? We can actually do this. util.df IB.open orders. So these are the open orders. As you see, it's two sell orders for Airbnb. One is the take profit of 150 and one is the stop of 143. And these are active. Okay. So you know what? Let's actually cancel these orders. So we can do, we don't really need to cancel it. But if you wanted to cancel, you can do for order in IB.open orders. IB.cancel order. So you could cancel order if you want. We're going to use this bracket order later. We can wrap it in a nice function to do all those steps for you. So 1 second. Sorry, I lost my my code for a second. So we can actually define this function. Oops. So this will just basically get the bracket orders and place them. So we're going to use that later. Okay, great. So that's the function to place bracket orders because we're going to be using that later. Let me see how much battery I have. 27 minutes. Okay. So let me show you guys now what I wanted to show you guys for the basically the callback. The what I really wanted to show you guys is that when there's a callback, when there's a new bar, or basically when a bar is done, meaning let's say now it's 11:27 Eastern, so the bar from 11:25 to 11:30 is completed. Once that is completed, you'll actually have two bars right after another. And you'll have the new bar, the 11:30 to 11:35 bar with volume is -1. Okay, so that's an important thing to realize because we're going to use that logic later. So let me actually show you guys this thing in action. So I'm going to basically print the last 3 bars every time we get a new bar update. And I'm going to also print the time and you'll see how it works. Okay. Okay, so you see the last bar is the 11:25 to 11:30 bar. And every 5 seconds you get an update on it. And as you see, the volume here did not increase, but you'd expect it to eventually increase. See the volume increase here, right? And when we have a new bar, it's gonna print has new bar, and you'll see what happens. Also note that this is at 28:16 and 28:21, so about 5 minutes, and then this is 28:30. I guess there's some latency here. 36. It's either 5 or 6 seconds, sometimes a little longer, sometimes a little less between bars, right? But you'll see when we get a new bar, it'll be one bar right after the other. So that's important intuition for the logic we're about to do. So let's just kind of wait because we have 50 seconds left. So I actually wrote this note here, but so I wrote it here. I should have it here. I should say like so when bar is completed, you actually get 2 bars right after the other, and the new bar has volume is -1. So we are almost there. 30 seconds left. Yeah, I gotta make better jokes for these awkward pauses. So we're at 41, 46, and now you'll see like 51. See, there's always some latency. It wants to be sure it has the full bar. So 56, and now look what. That's why when you're predicting also, you have to assume you can't make the trade right away. Look, this is 11:30, and then it has new bar. So basically, as you see, there's like a 1 second difference. Often it's actually less of a difference. And the only difference is these are the exact same, 94170, 94170, but like it gives you like the new bar with -1. So like, yes, you can be very, very sophisticated and you can already make your trade based on this bar, or you can be less sophisticated and you can wait until you have has new bar and realize that your bars ended at the one before. So I just thought this was good intuition for what we're gonna be doing next, because the idea, what I want to do is I want to like register for these bars pre-market, right? And then when you get a bar, when the market is open, the new bar will be the bar from 9:30 to whatever bar size you have. And once you get that new bar, then you can compute your features, apply your model and your gap trading strategy. Okay, so let's actually talk about all these components. And I'm sorry, I'm rushing. I'm just low on battery, and I don't have a port to put it in because everything is like a USB-C adapter. We'll see. Hopefully I can make it through. Okay, so this is for gap fill with buying and shorting stocks. Remember, this is fake. You should do this pre-market, of course. First thing is you want to learn a model based on past data for if the gap will be filled or not. Like you want to learn some sort of ML or statistical model. So I'm going to make like the dumbest model in the history of the world. So I'm going to have just 3 features: the gap percentage, the relative volume, and the day of the week. And I'm going to fit the dumbest model. The model is literally called dummy model. And I'll show you what happens. So assume like you did research on a different, you did a lot of research, you fit like the best model. You would do it like, let's say offline, you do some research, you have your features. Like I said, I'm only using these 3 features, gap percent, relative volume, and day of the week. And it's important that you need to have 2 labels for gap will be filled 1, won't be filled 0. So this is how our feature vectors look like, and our labels are 1, 0, 1. Okay, so now I'll show you how to use the dummy classifier. So it's important to write a strategy equals most frequent, and then you do .fit on feature labels, and then basically most frequent takes the most frequent one, which is the 1 class. So now when you do model.predict prob on features, you get 0% for label 0 and 100% for label 1. So that's a dummy model with the most frequent. If you do the default, it would just give you 2/3. It'll give you the ratio. Anyways, so like we want this one because we want to like assume that our model predicts gap fill all the time. Okay, so now that we have the dummy thing, and assume again like you did a much better model than this, you did a lot of research, all that stuff, then you would save the model. You would do like from joblib import dump model, and then you save it as dummy model.joblib. Okay, and then like now you want to run the gap fill. So you're gonna load the model, right? And loading the model, you do joblib.load, load dummy model. So I loaded the model. Okay, great. So now we have the model we're going to use to predict if the gap will be filled or not. Okay, so now the very important thing is we have to define our hyperparameters. So I just made something called min percent, gap percent. Is like basically the minimum gap percentage we're willing to make a trade on. So let's say if like a stock is gapping 0.00001% or whatever, like this. We don't really want to make a trade on that because A, it's not worth it, and B, the commission costs more than the gap, right? But if it's, let's say, 1%, or even 0.1%, and we're very confident, we probably can make the trade. So this is the min gap percent. This is the minimum gap percent we need to make a trade. A stock quantity is the amount we want of the stock we want to buy or short. I do emphasize that I hate shorting and I don't short. Slippage max is some hyperparameter. So remember when I illustrated the bracket order, I showed there was like a limit, take profit, and a stop loss. So basically there is no market order, but sometimes you want to like basically do a market order at market open. So I wrote the slippage thing, meaning like let's say you're willing to do a market order up until $5 in this case above the opening price. Obviously you would want a lot smaller than this, but because I just want to like show you guys like something working and getting filled, I set it to 5. But probably safer to set it to 0, no slippage, and even more safe if you set it to like negative I don't know a dollar or something. Okay, but like for now, because I want it to fill, I'm gonna set slippage max to 5, and then I have this parameter called stop loss to take profit ratio. This basically means if my take profit, if I buy the stock at 89, and yesterday's close was 90, so my take profit is basically $1. So this ratio, if it's equal to 4, would mean my stop loss is $4 below it. So it would mean my stop loss would be at 75. And I take profit at 80 and limit is 79. You're usually taught with brokerages the other way, tight stops, 3-to-1 risk reward. But if you have a wide stop, you're more likely to win. You have a higher probability of winning. You have to do your own research. I'm not giving good advice. Just saying like wide stops in my opinion is the way to go, but like not financial advice. This is just like because I hang on to trades and I don't cut my losses. But wider stop, higher probability of success. Narrow stop, you lose less at maximum, but you get stopped out a lot. Okay, and there's also a probability threshold. It's the probability like to make a trade. By the way, if your stops are tight also, by the way, like these big players kind of screw you over. So keep that in mind. Another reason to have a wide stop. And I threw in a couple of asserts. Anyways, these are the hyperparameters. And now we have to have the contract of the stock you wanted to trade, and the we have to get market data. We actually did this earlier when I kind of reminded you guys about market data. So let's just make sure we. So this is stock we wanted to trade, and this is market data. Okay, so let's just. Oh, sorry. To get market data, we did the rec market data like this. Remember, I'll just rewrite it here though, and let's see that we still are subscribed to market data. So yeah, so as you see, you have the close, open, and market price, and let's see if the market price changes. It changed, so we're still up to date. Okay, and now we request historical bars. This is something that's very important to note. Um, that the strategy I'm going to show eventually does not work with 5-second bars. And what's very important is my internet did stop, and this does not work when your internet stops. That's why if you really want to do something robust, you should do IB.rec real-time bars, because this does not stop. Okay, and then you would do your own logic for keep up to date equals true. Because we're doing the simplest solution, we're gonna do this with keep up to date equals true. We're gonna use 5-minute bars. I already showed you guys doing this above, but anyways, okay. So now let's get back to the juice. Let's get to the juicy logic. This is the most important part. So this is the basically the logic of the gap trade itself. Okay, so the logic is like this. I'm going to input bars and ticker, right? So the opening gap is the ticker.open minus ticker.close. The opening gap percentage change is basically this divided by yesterday's close, right? And here I'm just printing out the opening gap. Okay, so I'm assuming I'm going to run this at market open. So there is a basically 0% chance, but like in theory, this could happen where this ticker.open is nan because the market has not opened yet. So that's why I have this condition. That's why I have this while loop instead of just running it once. So if this if it's nan, meaning ticker.open doesn't exist, hasn't written it yet, then I write no open price yet, continue, and you keep doing this loop until you finally get ticker.open and hence the opening gap. So if it does have it, and by the way, it will always have it the way this implementation is, but you can have different implementations without callbacks where this is actually necessary. So that's why I have it this way. And assume all my code is buggy and wrong, just for the sake of it. So otherwise, meaning you do have this opening gap defined, you have this compute features where you're gonna compute the features we spoke about above. The features was the opening gap percentage change, the relative volume, and the day of the week are simple features. So once we have the features, we can feed it into our dummy classifier, do .predict proba, and then we take the prediction of the label 1, which meaning gap fill. If it's higher than the threshold we want for our likelihood of the gap being filled, then we are going to be okay with going to the next step of whether we want to make a trade or not. Okay, so here I wrote model predicts gap is filled. By the way, if this is false, model predicts gap will not be filled, and then it breaks from the loop because you only run this one time. Okay, so if it predicts the model is getting filled, there's two cases. You can have a opening gap being a greater than 0, that's a gap up. An opening gap less than 0 is a gap down. If there's a gap up, that means we want to short. I don't short, just to remind you guys. So like that means basically we're only willing to make the trade if it's worthwhile for us. So if the open is higher than the close, and then we had the slippage thing. Remember, if slippage max is like hypothetically, let's say $1, that means we're only willing to short if it's like up until $1 less than the open. Meaning, if the open is like $100, we're only willing to short at 99. So like this is kind of like a market order, but you want to prevent it from like, let's say there's a basically a jump down to like 60. And then the market order is like real slippage and you can't exist because it's always going to be a limit order, because remember the bracket order only does limit orders. So this kind of protects you from like real fast drop or whatever. For our example, I wrote slippage max is 5. Again, you can make this negative if you want like a limit to be even a higher gap up, which can be very smart and also it's safer. Or you can make it 0 if you want it exactly at the open price. So basically, this is saying kind of like the price you're willing to short minus yesterday's close, which is going to be a positive number because it's a gap down. If this is greater than the min gap percent, then it's worthwhile your time. And then you have this condition that the low is higher than the close, because if the low is not higher than the close, that means the gap has already been filled. That's why I have this else gap has been filled, right? And I should also I do place order, and then I should also do let me just have like a giant yeah, sorry, I should have a break over everything just in case I missed a break. Break. I don't know. I kind of changed this a few times, so assume everything I'm writing is wrong. Okay, but just in case. Okay, so basically, now the more interesting case for me is if the stock gaps down, you're a buyer, you're willing to buy, but you have this like slippage thing. So let's say it opens at let's say that yesterday's close was 100, it opened at 95. Instead of having like a straight up market order, say I'm willing to pay like up to $1 more. So the slippage max would mean my limit is 96 basically. So the percent change from open minus close divided by close has to be less than or equal to minus min percent gap. The gap has to be at least this big for it to be worth it. And again, this condition is saying if the gap has not yet been filled, meaning the high is still less than the close, then you're going to place your buy order, right? And otherwise, if none of these conditions hold, I wrote no gap opportunity. Okay, so let's see how this works in action. By the way, if the model's probability is less than the threshold, then you're just right. Model predicts gap will not be filled. Because we're using that dummy model and always predicts the probability 1, it's going to always get filled. Okay, so let me just see for a second that I don't have any open orders for a second. So I'll open orders. I do have open orders, so let me cancel them for a second. Order in IB.open orders. IB.cancel. Order. Great. Okay, and let's just make sure that our bars are still up to date. So util.df bars, yeah, we're at right before 1:30 Eastern, so we have this 125 bar. Oh yeah, sorry, it just is not a full bar yet. So if I click it again, you'll see that the volume went up. I'll click it again. The volume is the same, 49569, but I click it again, 49669. So it did go up. So yes, the keep up to date is true is working. If I keep this going, eventually you'll see one with the -1 like we said. That's the new bar. Anyways, that's the whole thing. Okay, so now the bars thing. So we have to now create our new callback. And the callback is going to be run one time at market open. By the way, you don't need a callback for this. You can just say like at market open, compute my features and make a prediction of gap fill or not. I'm doing it as a callback for no particular reason. Just for the sake of fun, I guess. But the market open is 9:30 Eastern, but we're way past 9:30 because I messed up. It's actually 1:30 Eastern. So that's actually would be like something like 13. The next in 5 minutes, it'll be 13:35. So it'd be like 1:35 Eastern. So like usually you would definitely do 9:30 Eastern when market is open here. But because I'm kind of like fake doing this gap fill, I'm assuming the market is starting at 135 just for the sake of this video. So what this thing is doing is it's saying, okay, it's attaching a callback on bar update. When there's a new bar, it's checking if that new bar corresponds to the market open. So what does that mean? It means that the new bar you got with volume equals -1 is the bar that's 9:30 to 9:35 if you have 5-minute bars, 9:30 to 9:31 if you have 1-minute bars. This works except for 5-second bars, and again, this does not work for IB.real time bars, which is what you should use for robustness, but for simplicity we're using it here. So when you have a new bar, you're going to just get a new bar with volume -1. And we're going to use that logic. Okay, so basically we're going to check if bars -1 .date .time equals market open. So in our case it's 13:35. If that's true, then I'm just going to print the volume for sanity check. It should give me -1. And then I call this gap trade function. I'm calling it with bars until -1, meaning except for the last bar, because remember, the bars -1 gives you the new bar, and we want until the last completed old bar. Truthfully, it doesn't make a difference with my features because I'm only using pre-market features. So anyways, I'm cutting it off anything that is in market hours. But this is just for best practices. I'm not taking the last bar because the last bar is not complete. In fact, it just started, so it's volume -1. And then I'm clearing the callback when it's done because you can only run these gap things one time, the opening gap things one time. So the one last thing we had was that we had this compute features thing. And I have 3 minutes until, because these are 5-second bars, until it's going to run again. So let me just explain what this compute features thing does. So what this compute features thing does is it basically takes these bars, creates a data frame. Since the data frame has a column called date, you know what? Let it if it runs and it'll do the trades. Let's see what it does. But after that, I'll explain. So right now we have no open orders. So in 2 minutes, it should do the trades. But meanwhile, let me explain what this thing does. So you can do this. You can do util.df bars. That gives you like the data frame of bars. And you call .date. That's the date column. .dt gives you like date functions. So you can do .week. Day of the week gives you the day of the week, right? And .date gives you the date rounded down. .date. In 1 minute, this should trigger, so I'll stop it in a second. So that gives you the date, the day. So now what we're gonna do is we're gonna since we want like relative pre-market volume, we're gonna set the index to date. Set the index to date, because then we can do this between time thing. 4 to 9:25. Why? Because pre-market starts at 4 Eastern and ends at 9:30 Eastern, and you have 5-minute bars, so it's 9:25. If you had 30-minute bars, it would be till 9, for example, and 15-minute bars till 9:15, for example. Okay, so that just takes only the pre-market, and then you group by day. You calculate the total volume in the pre-market. So that's the total volume in the pre-market, and then you do a moving average of the last 14 days to get the moving average of the last 14 days. And then, so you divide the pre-market volume by the moving average of the last 14 days. That gives you the relative volume. And you only need the last column. So, because you only need the most recent point for your prediction. So day of the week, we take df day of the week, .i loc -1. And relative volume, we take volume .i loc -1 over the moving average I loc -1. That gives us the relative volume. And then the other feature we had was opening gap percentage. So this returns basically this size 1 feature set. And then that gets fed into this this model that predict proba. And then it gives you a probability. In our case, it's always 1 because the dummy model. And then that's the logic. So anyways, it did complete. And it looks like I might have a bug because it ran a few times. That's why you should not trust my code. So like, let's just check, for example, IB.fills. We can look at our fills and we can do util.df. I must have ran this thing twice or 3 times. So I definitely made a mistake somewhere. I think I'm off on a break somewhere. So I'm missing a break. This was a gap down because it's Airbnb. And you place order, break, otherwise break. I might have attached a callback twice. You got to be very careful with this. That's why you should not use my code right now. So anyways, to look at the fills, you can do util.df ib.fills, but we only want the fill itself, so we can do f for f in fills. It's actually good I made a mistake. I mean, not really, but like it you can double check, right? Why on earth did it run twice? So as you see the fills, we had a buy order fill now, and we have a bug. Why? Because it filled it 3 times. And so now if you look at IB.open orders, we should see the other bracket parts, and you'll see that it's going to be 3 times, right? So because we accidentally did the order 3 times, we have 3 limits and take profits, as you see here. So that's not good. I have a bug. I wonder what the bug is. I'm not exactly sure. We can try again. We can say that the market open is here. Let me just cancel the orders for order in IB.open. Do not use this code. This is kind of like on the spot live doing these things. So be careful. So I canceling all the open orders, and now this would be like nothing. So now what on earth is my mistake? So I did this while true, right? And if this is nan, so maybe I'll print, and maybe I'll count. Let's see if this is an issue. I equals 0, and then I'll do like I plus equals 1, print I, just to give us some debugging. And then I said if missing the opening price continue, otherwise you compute features. It actually went to here. It placed this order, right? And went to if, so it placed the order, right? Oh, and yeah, so it should have gone here and it should have stopped, right? Well, apparently not. So I'm off by 1. I'm not exactly sure where I messed up, but I obviously messed up. So do not use this code. Let's just for the hell of it see if I set like a fake opening market to 1240 to 140. Let's see if it fixes it. I added like a little debugger, so this should only run 1 time. So if I get I equals 1, it's not a bug with this, it's a bug somewhere else. So at 140, and I made the slippage so big, and the min percent Airbnb is tanking after earnings. So Airbnb is a classic example of a gap not being filled. But you'll see like okay, so I did not have a bug here and only ran 1 time. Yeah, so apparently what my guess is I did I attached the callbacks multiple times without thinking while I had some downtime. But anyways, this is kind of just like an intro showing you guys. So, okay, yeah, we just filled the order. So as you see, like our latest order was just filled. This is 5 minutes later here, filled at 47.58. And we have our open orders is the bracket. We have the limit, which is we wanted 157.9. That was yesterday's close, so it's a huge gap actually. And the stop loss we put at 100. Anyways, I hope you guys enjoyed this video. It was a long video. Hopefully it will show this real time pre-market. And of course, if you guys are interested in the gap option strategies, please let me know in the comments. Thank you guys and have a great weekend.